Mansfield today, a brand new week, and as usual, we start that off with our business section brought to you by Capital Legacy, your number one provider of wills and estate administration. Our business guru is, as usual, Chris Gibbons. Chris, good morning to you. Top story today, an ANC plan to impose a whole new tax to fund a basic income grant. Tell us about it.
Yes, good morning, Jeremy. And as Fin24's editor Helena Wasserman commented, it's a bit of a shocker. I'll come to why in a moment, but how would it work, first of all? The idea is everyone right across the board would pay in between 8% and 12% of earnings, and everyone would get something back. Pay into a national social security fund. And earnings, by the way, means after-tax money. A basic income grant, given that there is such massive unemployment, is something that many people are thinking very seriously about. Needless to say, the rich would pay more than the poor. That's pretty standard, and the whole thing would probably be administered by SARS.
So why is she calling it a shocker then?
Several reasons. First, the green paper in which all of this was laid out comes from Social Development Minister Lindiwe Zulu. Is she freelancing or does she have cabinet approval, government backing? Well, National Treasury stepped in immediately to say the plan did not have cabinet approval, was not government policy, had not been tested against any fiscal targets. But I have seen at least one subsequent report that says she does have cabinet approval. What it does not have is NEDLAC approval. And Business Day this morning is reporting the release of the Green Paper ignores 5 years of negotiations at NEDLAC, including International Labour Organization research, which says that were it to go ahead, workers would be worse off than they are at present. Second reason, this government is singularly inept at administering funds. Think the UIF, Unemployment Insurance Fund, it's a disaster. Think about the Road Accident Fund. It's also a disaster. So you can imagine what would happen to a social security fund. And third, and in basic terms, it would add about 10% to your and my tax rate. We're already at 45%, for which we receive precious little. This could see a jump to as much as 55%. Let's call that about 3,000 rand a month, I would think. And put on top of that, don't forget, another 20% or so to fund the NHI. Pretty soon, Jeremy, there's going to be nothing left.
What's the reaction been, Chris?
Well, the plan's been welcomed by COSATU. They say it's long overdue, but most economists and the pension industry are up in arms. There's much talk of a tax revolt, but that is something that's very, very difficult to carry out in practice. Much more likely it would spur emigration, and that exacerbates an already severe problem. Too few individuals paying too much tax already, squeeze them even more, and they'll just run off somewhere else.
Okay, let's move on to China. Pressure by the Chinese government on its high-flying technology companies seems to continue unabated.
Yeah, I had hoped to be reporting this morning that things were starting to settle down, but no. On Tuesday of last week, we had a draft set of new regulations from Beijing aimed at tightening control of the tech sector, supposedly tackling unfair competition, companies' handling of critical data. And as we've discussed here before, it's all about control of the high flyers by the Chinese Communist Party. We heard President Xi Jinping talking about a more equal distribution of wealth and salaries which are too high. One related thought did occur to me, Jeremy. President Xi himself comes to the end of his second 5-year term early in 2023. Now, he's already paved the way to become president for life by having presidential term limits scrapped. By clipping the wings, though, of the big tech titans, the rich people like Jack Ma, he could be trying to drum up some popular support for that third term. We know that he will get the third term irrespective, but I think he thinks that it would be nice to have some popular applause going on while he does so.
Needless to say, I mean, continued pressure on Tencent means continued pressure on Naspers and Prosus.
Well, correct. They are, after all, joined at the hip. So yes, we saw both Naspers and Prosus sharply down last week, but that was also complicated by the big share swap between the two, which went down on Tuesday last. Huge volumes were traded as institutional investors adjusted their portfolios, 145 billion rands worth of shares in toto, and the JSE simply couldn't cope. So on Wednesday morning, it opened 5 hours late. Naspers down over 8% on that day. Now, from a high which saw it account for just under 25% of the entire market cap of the JSE, it now accounts for just 15%. And over in Hong Kong, by the way, all of this has forced the Hang Seng Index into bear territory. That is a drop of more than 20%. One other one to watch, of course, Bloomberg has an opinion piece which says that if President Xi goes ahead with the redistribution of wealth idea, then it's very likely that the relatively wealthy in places like Beijing and Shanghai will stop their ostentatious display of wealth, which of course certain Chinese are famous for. Now that could well mean a drop in sales for the likes of Louis Vuitton and Cartier and all of those luxury brands we know so well. Much of the very good growth in the big luxury goods makers has come from China. Two in particular, France's LVMH, and one called Richemont, which belongs to a certain Johann Rupert.
The once mighty CNA just continues to fade away.
Think back 20 years or so ago, Jeremy, CNA, one of the most dominant retailers in South Africa. Back then, I was CEO of the New Holland Strait group of companies, the illustrated book business. CNA was 40% of all of our sales at that time. When CNA said jump, we and all the other publishers in South Africa snapped to attention and said, how high? Goodness, they were powerful. Times have changed, though. Even back then, it was obvious that CNA's systems were antiquated, the company was very badly run, and round about then, don't forget, we also saw the birth of a small bookseller online called Amazon. Yep, and the South African equivalents followed quickly, all of which became Takealot. Now, CNA's been bought and sold several times over the years. Each time it gets smaller and smaller, and it's now in business rescue. Fin24 has a story this morning which says that the business rescue plan will see it shrink to just 55 to 60 stores nationwide. That's down from 163 at the present, and well higher than that back in that period 20 odd years ago. CNA still has very heavy head office costs, owes landlords tens of millions of rand. And the central question will be how quickly it can get those costs under control and pay down that debt. Otherwise, I'm very much afraid that CNA will become CN over and out.
Story that caught my eye earlier in the week, Chris, this call by Transnet for a private sector investment in its port division.
Yeah, that's an interesting one, isn't it? Transnet, according to its CEO, Portia Derby, is going to be looking for 100 billion rand over the next few years to jack up our ports. Three in particular stand out: Durban, Joburg, and Cape Town, and they stand out for the worst possible reasons. The World Bank says they are 3 of the 4 worst ports in the world. That's not the kind of accolade that we want, and it's about very high costs, very low efficiencies. Disastrous for a country like ourselves that lives and dies on exports. The 100 billion rand will be used to completely overhaul the container systems at these ports and to bring the whole thing into the 21st century, the modern world. Now, the idea is clearly based on the success that has been had by Telkom, the private sector brought in to run the company, but the state retaining a significant stake. So, will the Transnet idea fly? Well, in 1996, Telkom was brought into the private sector. Its first private partners came on board, a very different time. Don't forget, we've seen the full privatization of Iscor, now, of course, ArcelorMittal, Sasol, still Sasol. Times change, businesses change. Don't forget that both Sasol and ArcelorMittal have been through some very tough times, and the latter is still struggling. Going private, bringing in private partners, is no guarantee that your business is going to be automatically successful. South Africa right now, not a very attractive investment destination, though. But yes, I think a properly structured deal with the trade unions kept on as tight a leash as is possible, I think it could prove long-term attractive.
Okay, now try and pull it all together for me, Chris. How's this affected the markets or played out on the markets?
Jeremy, the markets generally are in a tough place at the moment. They're suffering from what one investor has called a toxic cocktail of events. Not just the Chinese crackdown, which we've been talking about, but also the retaking of Afghanistan by the Taliban, the continuing rise of COVID-19, and the really big one is this talk by the US Fed that it's thinking about starting to end its huge bond buying program, tapering of quantitative easing, reintroduced, of course, to help deal with the pandemic. And now that really spooked some investors last week. Month to date, the JSE is down 4.3%. That's the all-share index. Top 40 down nearly 5%. There's the Naspers process effect. Year to date, though, we're still up over 11%. The all-share, that is, the top 40 is up nearly 10%. Again, you can just see that little dip there from Naspers. Compare that with London, which is up 9.7%. We're in the same sort of zone there. But then think about Wall Street. The Dow up nearly 15% year to date. The S&P 500 18.25%. The Nasdaq up 14%. So we're not doing too badly, but we could be doing an awful lot better. Gold is under pressure as well, down more than 7% year to date. Platinum 9% year to date. The dollar itself has moved from 123 in early January to 117 around that mark this morning. 123 early January up to 117 against the euro. That's a gain of about 4.5%. And that has kept pressure on the rand. The rand down 4.5% against the dollar. Dollar up 4.5% against the euro, rand down. You can see how they move in tandem. We're flat against the euro, and down 4% against sterling. So right now, in my opinion, we need three things. One is a major ramp up of the vaccination program to try and get COVID-19 under better control. We need some very steady economic planning and messaging from the government, and clear evidence is the third thing that it can execute those plans effectively and efficiently.
Looking ahead, Chris, what's on the horizon?
Jeremy, looking ahead, we're also bracing for the latest quarterly labour force survey due out on Tuesday. We're expecting a rise of around 0.5% to a new record just above 33% unemployment. Astonishing number. As the year unfolds, the recovery from COVID continues. We're hoping that figure might moderate to just over 32%. The pandemic, don't forget, saw a net loss of 1.4 million jobs last year. 1.4 million. Again, an astonishing figure. But on a brighter note, let's end on a brighter note. This week we'll see the release of the latest mining production figures. Second quarter growth is forecast to come in at a whopping 22.5%, up from an already very impressive 21.9% in the first quarter.
Thank you, Chris. Thank you very much for your insight and input. We'll chat to you next week again. Have a good week. Chris Gibbons, our business, our financial. I don't actually know what to call him because he's everything. He seems to know everything. He seems to know all the inside tracks. So he's just the businessman of the show. Chris Gibbons will join us once again, courtesy of Capital Legacy, next week. Until then, thank you for joining us. And if you did enjoy that, please remember to hit the subscribe button. Until then, cherry bye.